Welcome to the Deep Dive. We're the show that cuts through all the noise to get you the insights you actually need to feel well-informed. Today, we are tackling a really big one: real estate investments. It feels familiar, maybe like buying a house, but honestly, it gets complex fast. We've got a stack of sources here, articles, some research, our notes, and it shows just how vast this landscape is. So our mission for you today, we're going to cut through the jargon, give you a really clear picture from owning actual buildings to buying public securities and how to value them, what role they play in your portfolio. It's going to be quite the journey, I think.
Oh, absolutely. Real estate is so much more than, bricks and mortar. It's a major alternative investment. And it's packed with unique opportunities, unique challenges too, very different from your standard stocks and bonds. This deep dive, it's really a key chance for you to grasp the fundamentals, but also those crucial little details that can make a huge difference. We're here to unpack why this space is so important to understand.
Okay, let's unpack it then, starting with a really basic question. If you want to put money into real estate, how do you actually do it? I mean, besides just buying a building yourself.
That's the perfect place to start. Broadly, you've got two main avenues.
Yeah.
Private investment and public investment. Now, private, that's where you get that direct ownership idea, literally buying, say, an apartment complex or some land. But it also covers things like private debt, basically acting like a lender, where your loan is secured by the property. And a really key area our sources focus on is private equity real estate. That's investing in like a pooled fund or a partnership that goes out and buys and manages properties.
Okay, so that's the private side. What about public?
Right, then there's public investment. This is usually more indirect. You might buy public debt, like bonds from a company that's heavily into real estate. But a big focus for us, and for many investors, is public equity. Think real estate investment trusts, REITs, or real estate operating companies, REOCs. A key difference right away. Private often means you need the expertise, the time, the capital for upkeep. Public, like REITs, you've got professional managers handling all that ownership stuff.
Yeah, that hands-on versus hands-off distinction seems massive. It's like two totally different games. So what does this mean for you, the listener? What are the fundamental things that make real estate just different from other investments? It's not just another asset, is it?
No, not at all. Real estate has its own very distinct characteristics. First off, high unit value. These are expensive assets, generally speaking. They're also heterogeneous. Every single property is unique, really. And it's got a fixed location. You can't just, move a building to a hotter market.
Right, can't just pick it up.
Exactly. And because of that, you run into high transaction costs. Like brokers, lawyers, taxes. Yeah, it adds up quickly. And here's where it gets interesting how these things connect. Because it's unique and fixed, it demands intensive management expense. Someone has to actively manage it, maintenance, rent collection, all that. Plus, properties depreciate. There's physical wear and tear, sure, but also economic obsolescence.
Economic obsolescence. Explain that a bit more.
Yeah, it's crucial. Your building might be in perfect shape physically, but if the main industry in town shuts down or zoning changes or people just move away for other reasons, the value can drop significantly. It's not about the building itself wearing out. It's about the economic environment around it becoming less viable.
Gotcha. That makes sense. So the neighborhood or city health is just as important as the roof.
Precisely. Another big factor is the availability of debt capital. You can often leverage real estate quite heavily. Loan-to-value ratios can hit 90% sometimes. But that means the cost and availability of that debt profoundly impacts prices and your potential returns. And a really critical one, you touched on it, illiquidity. It's not like a stock. You can't just click a button and sell.
Yeah.
Turning property into cash takes time. And if you need to sell fast, you might have to accept a lower price. It's a major consideration. All this complexity means price determination is tricky. There isn't a constant live feed of prices like the stock market. That's why appraisal managers and their expertise are so vital in figuring out fair value in what's often a pretty inefficient market.
Does the type of real estate change how illiquid it is? Like, is a small apartment building easier to sell than, say, a giant specialized warehouse?
That's a good question. Generally, yes. Smaller, more common types might be slightly less illiquid because the buyer pool is larger. But the fundamental illiquidity challenge remains across the board, really.
And speaking of types, you mentioned apartments, warehouses. What are the main flavors of real estate you can invest in, beyond just single-family homes?
Right. It's a broad spectrum. You got multifamily apartments, of course, then hospitality hotels, motels, office space, retail space, industrial warehouses, and even more specialized stuff like farmland or timberland, where the income comes from, selling crops or timber.
Interesting. Do they behave differently as investments?
Very much so. Hospitality, for example, can have really volatile income. It's super sensitive to business cycles, economic ups and downs, and it needs intense management. Now, if we connect this back to the bigger picture for your portfolio, why bother with all this complexity? Well, real estate offers some key benefits. First, income from rent. Second, potential property price appreciation. But really critically, it can offer significant diversification benefits. Our sources point out it often has a low correlation with other assets. Like, the correlation between bonds and the NARI index was cited as low as 0.14 in one study, much lower than bonds to equity.
So when stocks zig, real estate might zag, basically.
Kind of, yeah. It helps smooth out your overall portfolio returns. It also tends to act as an inflation hedge. Rents and property values historically tend to rise alongside inflation. Private real estate is often called a second-best inflation hedge. And finally, there are often tax benefits, especially if you're investing through private equity structures or REITs, which have that tax advantage status.
Okay, diversification, inflation hedge, income. Sounds appealing. But there's always a but, isn't there? What are the major risks you need to watch out for, especially with private real estate? It can't all be smooth sailing.
Definitely not.
But there's always a but, isn't there? What are the major risks you need to watch out for, especially with private real estate? It can't all be smooth sailing.
Definitely not. There's a significant dark side, if you will. First, general business conditions. An economic downturn hits demand, hits values. Pretty straightforward. Then, long lead times for new development. You start building now, but the market could be totally different 2 or 3 years later when you finish. That's a big risk. The cost and availability of capital, both debt and equity, are huge. If interest rates shoot up or banks stop lending, your project or your returns could be in trouble.
Right. That financing piece is critical.
Absolutely. And while we said it's an inflation hedge, unexpected inflation can bite you too. If construction or maintenance costs suddenly spike much faster than expected, that eats directly into your profits. Demographics are massive, especially for things like apartments. If the population shifts away from your area, good luck filling those units. And we keep coming back to it, but that lack of liquidity is probably the single biggest risk for many. Needing cash quickly can mean taking a painful loss.
Oof, what else?
Well, there's environmental risk. Discovering hazardous waste, asbestos, lead paint, that can mean enormous cleanup costs and legal issues. Often there's a lack of information in private deals compared to public markets. Your due diligence has to be incredibly thorough. Properties are usually leveraged, meaning you use debt. That magnifies gains, sure, but it also magnifies losses. Your return on equity can get hammered if property values dip even slightly. And finally, simple management risk. Having the wrong people managing the property can sink even a good asset. So yeah, this whole bundle of risks, especially the illiquidity and management needs, definitely impacts the risk-return profile compared to stocks or bonds. It's a trade-off.
That is a serious list to consider. Okay, so with all that, how do we actually figure out what a property is worth? You said it's not like checking a stock price, and you mentioned different types of value earlier.
Exactly. Before the how, let's quickly touch on the what. There isn't just one value. There's market value, what a typical buyer would pay in an open, competitive market. But then there's investment value. This is specific to a particular investor, like you, based on your own situation, maybe your tax bracket or your other holdings, or specific plans you have for the property.
Like my house being worth more to me because it's near my family, even if the market says X.
Precisely. That's investment value. Then there's value in use. This is about a specific user of the property, maybe someone already operating a business there. Their ability to generate income might make it worth more to them than to a general investor. And we also have assessed value, which is purely for property tax calculations, and mortgage loan value, which is a conservative figure banks use for lending purposes.
Okay, different values for different purposes. Now, how do appraisers actually come up with these numbers? What's in their toolkit?
Right, the approaches. The sales comparison approach, often just called comps, is usually the go-to if there are recent sales of similar properties. You find those comparable sales and then make adjustments for differences, size, condition, location, features.
Like Zillow tries to do, but hopefully more accurately.
Yes, hopefully with a lot more detailed analysis. The big challenge is always finding truly comparable properties and making the right adjustments. Then there's the income approach. This is key for properties that generate income, like office buildings or shopping centers. It's all based on the net operating income, or NOI.
NOI, that's basically income minus operating expenses, right?
Right. Income minus operating expenses, but before debt service and income taxes.
Got it. And how do you turn NOI into a value?
Two main ways within the income approach. First is direct capitalization. Simple formula. Value NOI divided by a cap rate. The cap rate is basically your required rate of return minus the expected growth rate of the income. It assumes pretty stable, constant growth forever, which is a big assumption.
Okay, simpler, but maybe less precise for complex situations. What's the other way?
The more detailed method is discounted cash flow, DCF. Here, you actually forecast future cash flows, rent collections, paying expenses, capital improvements over a specific holding period, say 10 years. Then you discount all those future cash flows back to what they're worth today. It's more complex, requires estimating a final terminal or sale value, figuring out lease renewal probabilities, much more involved.
Sounds like it requires a lot more guesswork, or maybe educated forecasting.
Educated forecasting, exactly. And finally, there's a sort of shortcut. Probabilities, much more involved.
Sounds like it requires a lot more guesswork, or maybe educated forecasting.
Educated forecasting, exactly. And finally, there's a sort of shortcut. The gross income multiplier, G. Value equals the property's gross income times a multiplier derived from comparable sales. It's less precise because it ignores operating expenses, but it can be a quick check. Often, appraisers will use multiple approaches and reconcile the results.
Okay. So you found a potential private deal, you understand the valuation methods. What about the homework, the due diligence? What does that really involve before you sign on the dotted line?
Due diligence is absolutely non-negotiable, especially in private equity deals. It's intense. You start with physical inspections. Environmental is huge. Checking for soil contamination, asbestos, things like that. And structural, making sure the building itself is sound. Then you pour over the rents and expenses. Is the zoning okay? Enough parking? Are there major master tenants? What's the real cash flow history look like? You examine past operating statements, utility bills, property tax records. Who was the previous owner? Why are they selling?
Digging deep.
Absolutely.
Yeah.
You also need a thorough legal history check, verifying clear title, no liens or unexpected encumbrances. Usually you sign a purchase agreement first, but it includes a due diligence period. If you find major problems during that time, environmental issues, misrepresented income, you'll renegotiate the price or, just walk away from the deal.
That period is your escape hatch, essentially.
It is. Now, once you own the property or you're invested in a fund, how do you track performance? That brings us to real estate investment indices. The traditional ones are appraisal-based, like the NCRI Property Index, the MPI. These rely on periodic appraisals of the properties in the index. But there's a well-known issue, appraisal smoothing.
Smoothing. Okay, you mentioned this can be misleading. How so? Like it irons out the wrinkles.
That's a great way to put it. Appraisals tend to lag behind actual market movements and don't capture the full peaks and troughs. So the reported returns look less volatile, smoother than they really are. This smoothing effect understates the actual risk, standard deviation, and makes the asset appear to have lower correlation with other assets than it truly does. So it can overstate the diversification benefit you think you're getting.
Wow.
Right.
Okay. So you might think it's diversifying your portfolio more than it actually is just because of how it's measured?
Exactly. It's a significant measurement bias. To combat this, we have transaction-based indices. These use actual sale prices, which avoids the smoothing problem. There are a couple of types, like the hedonic transaction index, which uses statistical models to adjust for differences between properties being sold, like comparing sales of houses with pools to those without to isolate the price change. Or the repeat sales index, which only looks at properties that have sold at least twice. This helps control for quality changes, but you end up with a smaller data set. The key takeaway is that how performance is measured can really affect your perception of risk and diversification.
That is fascinating and a really important point for anyone looking at historical data. Okay, let's pivot back to the public side REITs. We touched on them earlier. For you, the listener, remind us what REITs are and why they're appealing.
Sure. REITs, real estate investment trusts, are basically companies traded on stock exchanges that own, operate, or finance income-producing real estate. Think of them like mutual funds, but for property. The appeal. Well, investors look to them for current income, from rents passed through as dividends, potential capital gains as property values rise, inflation hedging, diversification, and certain tax benefits. The main type is equity REITs, which own the physical properties. You also have mortgage REITs dealing in debt and other related entities like REUCs. And as we mentioned, there's the whole world of mortgage-backed securities, CMBS and RMBS, which is actually a much, much larger market overall.
Got it. And you mentioned a structure called UPREITs. How does that work again? Sounds a bit complicated.
It sounds more complex than it is. An umbrella partnership REIT upright is just a structure that helps solve a tax problem. Imagine you own a building worth millions, bought it ages ago for cheap. If you sell it to a REIT for cash, boom, huge capital gains tax bill. With an upright, you contribute your property into the REIT's operating partnership in exchange for partnership units. It's not a sale, so typically no tax is due at that time. Later, you can convert those units into publicly traded REIT shares.
Ah, so it's essentially a way to defer the tax hit when moving private property into a public REIT structure.
Exactly. It's a very common and important structure in the REIT world.
So what are the main investment characteristics of REITs, and how do they really compare pros and cons against investing in private real estate directly?
Okay, key characteristics. REITs generally have that tax advantage status. They don't pay corporate income tax if they distribute most of their taxable income, usually 90%, as dividends. This leads to high dividend yields typically and relatively stable reported incomes. You get professional management, often access to higher quality properties, and diversification across many assets within the REIT. Plus, you get the protections of public companies, financial reporting standards, corporate governance rules, and usually more limited leverage compared to private deals.
Okay, sounds good. What are the advantages versus private?
The big ones are liquidity. You can buy and sell shares easily on major exchanges. Lower minimum investment, you can buy just a few shares versus needing huge capital for a direct purchase. And limited liability, you can only lose what you invested in the shares.
Makes sense. And the downsides?
There are definitely trade-offs. Those dividends, while high, are usually taxable as ordinary income for the investor, which might be less favorable than the potential capital gains treatment in some direct investments. Critically, REITs tend to have a higher correlation with the broader stock market compared to private real estate. So they might not provide as much diversification benefit, especially during market downturns. They can also be more volatile day to day. You can also have structural conflicts of interest, particularly in things like UPREITs, where the original property contributors might have different goals than public shareholders. Growth potential can sometimes be moderate, and REITs might be forced to issue new equity when their share price is low, diluting existing shareholders.
Right, so that correlation point is key REITs might move more like stocks, while private real estate might offer more of that unique zig when others zag diversification. If someone's looking at investing in a specific REIT, what kind of due diligence should they do?
Good question. It's different from checking a building's foundation, obviously. For a REIT, you'd look at things like the average remaining lease term across its portfolio. Shorter terms might be good if you expect rents to rise, longer if you fear a downturn. Look for inflation protection. Do their leases have clauses that automatically increase rent with inflation? You need to perform market rent analysis, compare their current rents to prevailing market rates to see if there's upside potential when leases expire. And consider the cost of releasing space, tenant improvements, broker commissions. These costs eat into returns when tenants turn over.
Okay. And how do you value a REIT? Is it like valuing a regular company stock?
It has its own specific metrics. A key one is funds from operations, AFFO. It's a measure of operating cash flow used widely in the REIT industry. However, many analysts prefer adjusted funds from operations, AFFO. This is generally seen as a superior measure of the actual economic income available to distribute to shareholders.
Why is AFFO better? What does it adjust for?
AFFO starts with FFO, but then subtracts recurring capital expenditures needed to maintain the properties and adjusts for things like straight-line rent adjustments and leasing commissions. Basically, it tries to capture the real cash flow after accounting for the costs of keeping the buildings competitive. It's a truer picture of dividend-paying capacity.
Gotcha. More realistic.
Yes. So you can value REITs using relative valuation multiples, like price to FO or price to FO, comparing them to peers. Or you can use a discounted cash flow approach, often a dividend discount model, DDM. Makes sense given that REITs pay out significant dividends.
Okay, one last quick point. Debt. We know it's big in real estate. How does borrowing fit in, and is there a key ratio lenders look at?
Debt is absolutely fundamental. It's the lever that often magnifies returns and risks. A critical metric, especially for lenders assessing a property's ability to handle its mortgage payments, is the debt service coverage ratio, or DSCR. It's a simple ratio. The property's net operating income, NOI, divided by its total debt service, principal, and interest payments.
So what's a good number?
Lenders typically want to see a DSCR above 1.0, usually greater than 1.2 or 1.25. That means the property generates 20–25% more cash flow than needed just to cover its debt payments, providing a safety cushion. Lenders will use this, along with interest rates and NOI, to figure out the maximum loan amount they're comfortable extending.
All right, so wrapping this all up, what does this deep dive mean for you? We've covered a lot of ground, from owning property directly to buying REIT shares, the unique traits of real estate, how it's valued, the risks, the rewards. It's really clear that real estate isn't just one thing. It's incredibly diverse, pretty nuanced, and it can play a really significant role in your portfolio income, growth, that important diversification piece. But wow, it really demands you understand the specific game you're playing, whichever part of the real estate world you choose.
That's perfectly put. This exploration underscores that knowledge is absolutely critical in a market that often feels, well, opaque. And maybe that leaves you with an important question to ponder. Given that private real estate is illiquid and management intensive, but offers potential diversification and inflation hedging, how can understanding these different valuation methods, market value versus investment value, for example, and the specific risk factors, empower you to maybe spot hidden value or see risks others might miss? Think about how that difference between what the market says something is worth and what it could be worth to you based on your unique situation might shape your own investment approach in this complex asset class.